Hello, everyone. This is Dr. Duru from Ahan Analytics presenting the market breadth from 122. All right, the market action today, the main thing I wanted to point out is from Swing Trade Bot. Again, I have a subscription, I'm a big fan, is that the short-term trends are essentially bullish. Not only that, but the key signals from today are all bullish. I don't follow the MACD technical indicator, but I am taking note that Swing Trade Bot is flashing bullish signs for the very short term. So that's important context when I take you through the charts of the day, starting with market breadth. So ironically, and let me change the scale on this, despite the bullish signals today, market breadth actually went down and it fell below 30%. This is sort of a bearish divergence. It represents some weakness that you'll see later in the charts from small caps. I'm not sure whether to consider it a major thing yet, but we'll just have to see how things play out during the week. If we just look at what happened last time, market breadth was around this low, hovering above the oversold level. It's not unusual for market breadth, and again, this is the percent of stocks trading above their 50-day moving averages. I call it AT50 for above the 50. You'll see that it'll come down sharply to a point, it'll have a relief bounce, come down to a lower low, and then bounce up. I actually would like to see a lower low because that would put market breadth at official oversold levels, at which point I could get much more aggressive. I'll feel more comfortable getting much more aggressively bullish. But for now, I'm cautiously bullish on the stock market. Let's take a look at AT200, which is the percent of stocks trading above their 200-day moving averages, and you'll see that that also came down. So this validates or agrees with the short-term market breadth signal that they both went down. So that's a cautionary tale to any bullish signals you see anywhere else in the market. All right, let's go back to logarithmic and let's go through the indices. So the S&P 500, now I have to break this down by the 15-minute chart again, because while you see a lot of churning action on the daily, there's actually a lot of interesting stuff going on underneath. And you'll see what I mean when I flip to the 15-minute chart. Back on Wednesday, I claimed that the pre and post Fed trading on Wednesday was going to be a defining range for the S&P 500 for a while, and sure enough, it was. The very next day on Thursday, market makers gapped down the market. Buyers stepped in right around the point at which the market rallied when the Fed released its statement. The rally then lasted, what is this, about an hour, hour 15. And then buyers magically lost or got exhausted right at the post-Fed high. And then the sellers took over all the way down. Then when the market makers gap the S&P 500 down again on Friday, they were able to break this low and probably stopped out a lot of traders who only wanted to be in the market if this low held. But then look, there was very little follow through. And after some churn, the buyers slowly crept back in. What happened here at the very end or the very close of the day is important. Apparently, Trump expressed some flexibility with tariffs. It's not clear at all, of course, what that means, but the market chose to interpret that positively. And on CNBC's Fast Money, it's funny, they went through a bunch of F words, the F starting with flexibility. And I think actually that flexibility word is going to be pretty important because if I flip back to these daily charts, I'm going to do some trade school stuff here, which is to advise folks who are trading short term not to get too carried away with existing momentum to the downside or to the upside. So that F for flexibility means traders are going to have to be very flexible because at any time there could be a tariff headline, positive or negative, and it's going to upset all sorts of trades. So for now, the market, I consider this right here, this down trend, to be everybody who cares about tariffs is getting out the market. And then when everything stops, is presumably where all the people who actually care about tariffs are finally out of their positions, out of the market. But we don't have a positive catalyst yet to really push the index much higher. So if we don't get a strong push higher, then this dribbling up is probably going to hit stiff resistance right here at the converged 20-day and 200-day moving average. And certainly the downtrending 50-day moving average is going to be tough to break as well, unless there is some strong positive catalyst. So let's take a look at the Nasdaq. Nasdaq, of course, is in a worse position than the S&P 500 because it is just totally flat for the last, what is this, 2 trading weeks. And not really much to say here. It's still well below this 200-day moving average, still in bearish territory. The small caps, I bought my traditional, not traditional, but I bought a call option just because there was sort of an extreme move with this gap down to the lows. As I mentioned before, I expected the 20-day moving average to be tough resistance, and that's exactly what happened. The post-Fed rally stopped cold right at that resistance. The next day, the intraday high stopped right at that resistance. And finally, buyers were exhausted enough to just let IWM gap down to where it did. So this is where the weakness in market breadth happened, I assume, or a lot of it. And it's definitely something we've seen in previous year or two that the small caps have been relatively weak compared to the Nasdaq and the S&P 500. So it makes the otherwise bearish signal from this divergence in market breadth hard to interpret. So again, that's just context to keep in mind as we go along in the trading days and things are bouncing all around. Finally, let's take a look at the VIX. The VIX is continuing to dribble down now below 20. 20 is the elevated level as a reminder. And, I suspect it'll continue to come down a little bit more, maybe stop coming down around the 50-day moving average and 200-day moving average. And that's because we now have this countdown going for the April 2nd tariff. And if you have any kind of risk management going on, you have to be prepared for some kind of bad news. So if the VIX goes too low ahead of that April 2nd deadline without any positive catalyst, that's going to be a red flag to me. That'll be like just complacency taking over all over again. Okay, sorry for the sniffles. I've got a fighting a cold here, so I got to wrap this thing up. Uh, let's go ahead and jump into the individual stocks. I have some interesting patterns here to show. Um, American Express rallied right to two, and my individual stocks are going to show some very key technical lessons that remind you why the technical signals are important, whether it's for ETFs, indices, or individual stocks. Notice American Express, AXP rallied right to the 200-day moving average resistance and stopped cold. This is after the Fed tried to rally through it, it failed, and today it's below that again. Now, there's good news and bad news here. The bad news is if it keeps hitting resistance and failing, that means that it's probably weakening and the next move will be down. But if American Express manages to close above the 200-day moving average after failing so many times to break through, that should be an all clear signal. So I'm watching that very closely for either a bearish or a bullish trade. TJ Maxx is a retailer that I consider to be well loved. And you'll see that even TJ Maxx suffered in the March sell-off. And it too rallied right to 200-day moving average, right through it a little bit on the post-Fed move, and then failed back below it. So again, 200-day moving average, very important technical signal. Now here's one that I was fascinated and surprised by. Darden Restaurants, they own places like I think Macaroni Grill. Oh wait, I think it's Macaroni Grill and Olive Garden. Um, Somehow they're one of the few casual dining restaurants that are still seeing good results. This is good sign for consumer spending, or at least some small segment of it. You see this big move down that seemed to confirm a failure, a bearish failure below the 50-day moving average, is red line. Earnings was a pop of 5.8%. So Darden is back in bullish territory, which is doing pretty good considering the overall market. On the flip side, I don't know what's going on with Jack in the Box and there are other casual dining or fast food restaurants like this. Jack in the Box was down yet another 4% today. It has just been pounded, 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 pounded. And it is now reaching close to the pandemic lows. So I don't know what's going on with Jack in the Box. Maybe if you do, you could put it in the comments, but it is suffering a big downtrend. The reason why I've been paying more attention to this is because my daughter is in a stock trading contest in her economics class, and I put her in Jack in the Box because it's one of her favorite places, and I thought um, it would just hang around. Actually, there's more to the story, but just basically say that I started her off with a bunch of stocks that she knew and that I figured wouldn't move that much until I could really get active with it. And I made a huge mistake putting her in Jack in the Box because it proceeded to collapse after I put her into it. This was in early February, and it took me a while to finally clear her out of this one. So anyway, this is Jack in the Box going the complete opposite direction of Darden restaurants, and it's in a steep downtrend. All right, let's go back to some other stocks of interest. We have, excuse me, Accenture, and Accenture is a consulting company, management consulting company. I think it does still some IT consulting. I may not be correct in that, but I know they probably have a lot of major government contracts. So this is one to watch. They dropped what is the 7% post earnings today. It recovered a little bit by 1.5%, but this is basically a broken stock with the bearish 200-day moving average breakdown confirmed. All right, Upstart. Now here's another one where there's a different kind of pattern for the 200-day moving average. It's just pivoting around it. So I don't know why traders like to do this kind of thing. I mean, just pivoting around one of the key moving averages. But what I like about this kind of pivoting is that once this consolidation period is broken, either to the upside or the downside, it provides a clear signal to trade in that direction. Upstart Holdings is a financial or fintech company. Dollar General is one that I actually snuck into today. It's being really sneaky here. It had a decent earnings day. It got up 6.8%. And I know it's been a dog. I mean, you can see how much it's collapsed. But for the short term, there seems to be a bearish to bullish reversal slowly but surely unfolding here. So I got in with a call spread 85 to 90, just a very small risk, small reward play just to trade on what I presume will be continued creep higher towards 200-day moving average resistance in the coming month. And Dollar General is a discount retail store. Lululemon, definitely not a discount retail store. It is not quite pivoting on its 200-day moving average, but it's definitely holding that support. And it has earnings coming up next week, so I am going to have this one on my radar. I I highly doubt I'll dare to trade it before earnings, but I'm very curious to see how this one explodes lower or higher after earnings. You can see Lulu looked like it was making a big major recovery back in December for its last earnings and went up 15.9%. All those post-earning gains are gone, long gone, and it's just a reminder. Sometimes the market itself has no idea how to interpret earnings results. So all of those excited gains are gone, and now it's up to the next earnings report to deliver the next catalyst. I've shown the European stocks before. You know what to do. It's traded gently back to the 20-day moving average, which was held as support all year. I technically should have bought some today. I hope I didn't miss my opportunity. I'm going to have this on my buy list for Monday. I know it seems kind of odd to buy Europe, but the governments, particularly in Germany, are talking about spending more money, and the stock market loves it when governments spend money, believe it or not. Um, the stock market knows where the money flows. Okay. Oh, I forgot one other fast food or casual dining stock, Chipotle. I've covered Chipotle to great. I've covered Chipotle a lot in the past I don't know, almost a year now. Um, and it's at a critical point. If you see here, when the CEO bailed for Starbucks, that was a major low and it recovered. But over the last, what is this, 3 months? Yeah, 3 months, it has just been, with except for a small break, it's been steadily dripping lower and it's testing this low again. I am long Chipotle. I'm trying to hold it for the long term, or longer or longish term. But this is pretty precarious. If these lows don't hold, who knows how far down Chipotle will go. If that low breaks, and sorry for all the mess that happens when I go to a longer term time frame, it means that Chipotle is putting on a major top here. That, it last made its all-time high back in June of last year. That's a long time to go. I'm sure a lot of holders are getting impatient, wondering when Chipotle will resume its well-loved status. As a reminder, Chipotle can have these long down runs. I've covered this before. So, of course, from 2021 through the bear market, it had about a year and a half, or actually a little over a year, where it just continued down. We're not even in a bear market, and Chipotle is struggling, and we're going on a year. So it needs to turn up sooner than later. Whether it's the calendar needs to wake this thing up, or it needs to hold the support. I don't know, but obviously I had this one also. I'm watching very closely. Now, finally, we have, excuse me, Landstar System. This is a transportation company that specializes in cargo, truck cargo between Canada, the US, and Mexico. It is practically ground zero for tariffs. And I'm ending on this one because I find it fascinating that, uh, despite knowing that tariffs were going to be on the menu, this stock surged after the election, 6%. And soon after that, it got a little higher and it hasn't been higher since, as I think reality started to dawn on people who hold this stock. And it's been going down ever since. I'm trying to pay more attention to Landstar system because this could be a key indicator of what the market thinks about the prospects of tariffs. And right now, the market believes that tariffs are a real prospect and are bad for a company that is right at ground zero for North American um, shipping. I'm also pointing it out because today the stock went up 1.7%. And actually, let's look at intraday to see if it benefited from Trump's flexibility comment. Well, it was rallying all day today. Maybe someone got the drop, maybe someone heard rumors or something, but you can see at the very end of the day, it did get a little pop there. So it's interesting to see that it actually rallied into Trump's comments. But anyway, this is a good one to keep an eye on. I don't have an opinion either way on going long or short this stock. I wouldn't want to be in a ground zero tariff stock just because, as I said at the top of at the top of this recording, the headlines are going to swing around, and this stock will swing around with that, and it might drive a short-term trader nuts. So anyway, that's all I have for today. Subscribe to this channel. If you want more content like this, I put more details on my blog at drduru.com/122. And if you have any questions or comments or feedback, put them in the comment section. Otherwise, I will see you later, and hopefully I will be over this cold by then. Thanks for bearing with me.